What's up, everybody? Good morning, good afternoon, good evening, wherever you're watching from. This is Max Pitts with Trades and Gains. I'm here to talk about some FlowScanner action that happened on Friday for us, okay? This is where we're going to break down what institutions actually did, not what Twitter think they did, okay? This is all about real money, real time, real bets happening in front of your face. This is a big picture close to the week. And honestly, the flows today tell a very clean story. There was index hedging, selective mega cap, call buying, defensive plus gold exposure, and very little YOLO behavior. So if you're wondering why price action feels heavy, why rallies keep stalling, or why volatility is refusing to die, well, the answer is in today's flow. Let's walk through it ticker by ticker. So, SPY, that was our winner chicken dinner of Friday. We had 49.38 million in total flow, with 3 million going into calls against 46 million going into puts. The most common contract were the February 20th, 2026 660 puts, okay? Let's go ahead and make that a little bigger for y'all. So those 660 puts are what were dominating the tape, right? And it was a high frequency. We had 10 hits on this alone. This is not bullish positioning. This is what we like to call some portfolio protection. Institutions are currently rolling downside hedges, protecting gains from Q4, and preparing for macro landmines. Think rates, data, and policy risk, right? Because we have a lot of that going on with Trump trying to take over Venezuela, buy out Greenland, and all these other insignificant countries. What do we always say here? If it's one thing the market hates, it's uncertainty. Now, the key takeaway from this is two things. One, this isn't panic selling. This is what we call professional risk management. The market is being insured, not necessarily chased higher. As DV Jones said in our stream today, from Friday, a lot of times institutions like to drive the price up and then dump it on retail, basically. So when SPY flow looks like this, rallies can happen, but they are very, very fragile, meaning we could see some very aggressive downside moves from our favorite index. Now, next up, we have QQQ. This was a completely different tone that QQQ was giving out. So when we go and look at the QQQ contracts, we had 3 hits on the 630 calls due for, well, the 23rd of this month, okay? That shows some short-term bullishness. We had 35.6 million in total premiums, with 27.46 million going into calls against 8.15 million in puts. All right. Now, the frequency, we would consider this low to moderate. This is targeted bullish exposure. This is not broad tech euphoria. Think about that, okay? Institutions are betting on mega cap leadership. They're favoring AI and platform names, and they're avoiding small cap or junk tech at this point. The important nuance here is QQQ calls plus SPY puts equals barbell positioning. They're saying we like the leaders, but we don't trust the index. That's classic late cycle behavior here. And again, it's those 630 calls due for January 23rd of 2026. We had a good amount of money, about over 700K dumped into these as well. Now, next up is Tesla, where we're seeing some aggressive bets, but they're very much controlled. And this is one that really stood out to me today. We had 18 hits, by the way. 28 million in total flow, 26 million going into calls against only 1.98 million into puts. That QQQ exposure is starting to make a little more sense, right? So we're looking at the 445s, right? This is delta hedging due for 1/16 of 2026. So January 16th of 2026, we saw a good amount of money get dumped into these, okay? I mean, we see 413.17 just hitting the board time and time again. This is what I like to call a conviction buy. This isn't hedging. These aren't spreads, and it's not noise. Institutions are currently leaning into volatility, event-driven upside, and momentum continuation. But here's the key. This isn't all in Tesla to the moon. It's controlled risk with defined contracts. Tesla remains a trading vehicle at the end of the day. It's not a long-term safety asset yet, right? We had some good news come out of Elon with being able to sue OpenAI, XAI, got 20 billion in funding that's backed by Nvidia. So this all really makes sense when we're looking at Friday. Now, next up, we have GLD. We have GLD as our next hottest contract. It's quiet, but it's definitely one of the most important because, well, unfortunately, gold matters more than I think people like to admit. In total premiums, we saw 23.54 million with 19 million in calls against 4 million in puts. Now, when we look at our most hit contract, it was those 415 calls due for next week on January 16th of 2026. We had about north of 580,000, almost 600K dumped into these contracts the other day. Okay. Now, the frequency of this was low because it only got hit twice, and this is what I like to call strategic allocation, not speculation. Institutions buy gold calls when real yields are unstable, policy uncertainty rises, and they want non-equity convexity. Gold doesn't scream panic, it whispers insurance. And combined with SPY puts, that's not bullish for risk. Because think about it, SPY was leading significantly over their calls today, despite the rally that we saw in our session on Friday. Now, what that's going to go ahead and tell me is because we saw that bullish move, it seems institutions are trying to trap retail into calls and dump on them into next week. And that's why we're seeing that GLD flow just stand out so heavy. Again, we have 19 million against 4 million. That's almost 4x in call volume, okay? And a lot of times we can use GLD as that bellwether, right? Now, the next ticker that we're going to talk about is Netflix, and it showed up quietly but clearly here. We saw 17 million in flow, 16 million going into those total calls against 900,000 in puts. Now, our most hit contract were the $88 calls for January 23rd of 2026, right? Great position. We saw, this is what we like to call conviction as well. We saw 11 hits here. This is an earnings / catalyst positioning, okay? This is not macro. It's not hedging. This isn't even remotely close to fear. Institutions are playing subscriber expectations, pricing power narrative, and post-earnings volatility. Netflix remains a stock-specific trade, not necessarily a market signal, meaning that when we do trade Netflix, it's typically going to be based on a catalyst, meaning we see institutions loading the boat, getting ready for some kind of move to take place here. Now, IWM will be the final one that we're going over today. With IWM, we saw our most popular contract at the 261 puts due for January 12th of 2026, right? We saw about $400,000 dumped into these, and this is a vote of no confidence in this case, right? Small caps, think about it. They're sensitive to rates. They depend on growth acceleration, and they struggle with tighter financial conditions. They can't afford these 20-year high rates that we're currently stuck in, right? So that's why we see IWM run when rates seem to be going in their favor. That is what I'm reading with this, okay? Institutions are currently fading IWM because if the economy slows, guess what? The small caps will be the first one to feel it. Now, we had 16 million in total flow, with only a million going into calls against 14 million going into puts. That should tell you everything you need to know about how institutions are positioning. So let's go ahead, make like a condom, and wrap all this up for you guys to make it easy for you to understand. What did institutions do today on Friday? Well, they hedged the index. Think SPY and IWM. They bought the selective leaders out of the group, and that's where we're going to talk about QQQ and Tesla. And then they added protection, right? GLD, and they even took event risk with Netflix, okay? Now, what they did not do was a broad risk on, no speculative junk, and no meme chasing. The market message is simple but clear. We're cautious, not bearish, but we're not chasing either. This is the kind of environment where the chop is going to dominate, headlines move markets, and flow matters more than the narrative. And that's why we track it. That's why I do these episodes daily. Now, if you're trading blind without flow in a market like this, you're just basically guessing. This is exactly why Investor Central Club exists, to see what institutions are doing in real time with real contracts. Not your friend Jim who bought one SPY 0 date to expiration call, but what are the institutions actually buying? And by the way, we get to do this before price confirms it and before retail even begins to realize it. Now, if you found this helpful today, make sure you like, subscribe, and share it with someone trading without a plan currently. We'll be back next week on Monday on our next episode, but if your buddy is still trading blind, make sure you have him sign up for Investor Central Club. Use Stacks Apex, that's STAX Apex, to get 20% off their first month. Most people are able to recoup and make their subscription back within that first month off the calls alone, or call outs in this case. So yeah, what are you doing? You want to keep trading blind, or do you want to come hang out with a winning team? I hope you guys all have a great Saturday today. Let's go with some NFL football bets later on the day. Make sure you like, subscribe, comment, and share this again with somebody who's trading without a plan. I love you guys. Thank you for the support. We're one subscriber away from 900. Who will it be? Hope you all have a great Saturday, and I'll see you in the next one.